All right, so we are on chapter 14, long-term liabilities. And in these videos, I'm only going to make two videos. I'm going to put learning objective 14.1 and 14.2 together, and then I will do 3, 4, and 5 together. 5 is really, really short. And then we're not going to do any of the rest of these, okay? And I didn't assign you any homework out of those sections. All right, so let's get started. Learning objective 14.1. I drew the accounting equation out here just so you kind of see where we're at now. We did a whole chapter on current liabilities, chapter or previous chapter before last. Okay, chapter 11 was current liabilities. We are now looking at long-term liabilities. Okay. So these can be long-term notes payable. It could be a mortgage payable. Um, Primarily, we're going to talk about bonds payable in the context of this chapter, but they give us a little problem to do right off the bat. We have December 31, 2025. Smart Touch Learning signs a $20,000 note payable. It is due in 4 annual payments of 5,000 plus 6% interest each December 31st. Okay, so the journal entry on December 1st is just to debit cash and credit notes payable. Sometimes there's a lot of noise going on in those problems, and they give you a whole lot of information that you might not need right this minute. Okay, so you really didn't have anything to do anything with all of those other numbers, but for the journal entry right then was to just record the notes payable. Okay. Then they're going to give us an amortization schedule. And let's just jump down here to it. Um, if you have bought a house, bought a car, sometimes they'll give you an amortization schedule and it will list out all of your payments that you have to make on whatever that is. And a lot of times they'll add that number up of all your payments. Don't do that. That number is as irrelevant as any number on the planet, okay? Because if you finance your house out over 30 years, you're going to have interest on that. But if you look at that number, you're comparing dollars in year one to dollars in year 30. Those are not the same dollars, okay? Those aren't the same dollars. We don't really care about that. So don't look at that. A lot of people will try to show you that so you don't have debt. But you know what? Buying a house is much more, it's much more economical than it is to rent until you can afford to buy a house with cash. You're already paying rent. You're already, I mean, most of the time house payments are less than rent payments, okay? Unless you just don't, if you just want to rent because you don't want to deal with anything, you don't want to deal with the hot water tank going out or anything like that, then you know what? That's fine if you want to rent. Okay. We have been very lucky in the houses that we bought. We bought at a good time and sold at a good time. So it's been really good for us. But, you know, we're getting older and we might choose to do something different later on. Okay. So here is the amortization schedule for that note that they are talking about. Okay. And we have this balance because that note was open on December 31st. They did that to help us out on the interest. Okay. We didn't have to cross a year end on the interest. Okay. So the beginning balance was 20,000. They're going to pay $5,000 principal payment plus the interest. Okay. And so we're doing simple interest here. We're not doing compounding interest. Okay. So that is principal multiplied times rate multiplied times time. Okay. And the principal right there was 20,000. The rate was 6% and it was for a whole year. So we're just going to multiply that times 1. Okay. If we did that, I'm going to do it in the calculator just because I probably should have had it pulled up. That way you can see, because I'm going to do the next one also in the calculator. So you can kind of see the difference between as those payments and as that principal starts falling. Okay. So 20,000 multiplied times 6%, that is 1,200. Okay. So they have to pay 5,000 on the principal and the interest at the end of each year. So they will make a total payment at the end of year one for 6,200. Okay. Well, now our principal is dropping down. Our principal has dropped down to 15. Okay. So let's erase that and let's look at this. Principal is 15,000 multiplied times 6% multiplied times 1. That we don't have as much principal now, and that is going to make our interest costs go down. Okay, multiply that times 6%, and there is the 900 interest in year two. Okay, and typically this is how most loans work, not necessarily the principal plus the interest, because usually you're going to pay the exact same amount every single month, and but the difference is going to be that on the front end, you do have a lot more principal on the front end. So I don't know if you've ever heard the term, you pay most of the interest up front on your loan. That is true because you have a higher principal. Okay, so there's less money going towards your principal. Okay, so that is why it's like that. Again, even with that, it is still a lot of times more economical to buy a house than to rent one. Okay. So you can see how this goes all the way down to 0. This is an amortization schedule. Okay. So then on December 31, they said Smart Church Learning must make the first installment payment of $5,000 plus the interest, which we just calculated up there. So $6,200 is going to go out. Okay. So cash will leave of 6,200. Notes payable is going to go down. Okay, I'm going to draw out that notes payable real quick. We credited notes payable for 20,000 in that first entry, and now we're debiting that notes payable to bring that principal down to 15,000. Okay, so that's why we're debiting that payable because we have, and we don't mix the note and the interest together. We keep them separate. Okay. So then we could have made the journal entry for the next year because the journal entry is going to be identical. We're just going to use different numbers. We'll use these numbers, right? Sorry about that. We're going to use these numbers for the next year. Okay. So get my slide back over where it's supposed to be. There we go. All right. So mortgages payable, these are long-term debts. They are backed by the security of a specific property, and there is usually a lot, the interest on mortgages is usually a lot less than, say, like your credit card debt. Because your credit card debt, that's like unsecured debt. Okay, that's probably the worst debt to have. Okay, it's unsecured. The interest you pay in that is not tax deductible. If you purchase a home and you have home mortgage interest, then that is actually tax deductible. Okay, student loan interest. If you take out student loans, then the interest on that is also tax deductible. Okay, so there's good debt and there's bad debt. Okay, so mortgage payable, they're very similar to long-term notes payable, except that mortgages are usually payable are secured with a specific asset or a long-term notes payable or not. Okay, so here we have an example for mortgages. So we are on December 31, 2025. Smart Touch Learning purchases a building for $150,000, paying $49,925 in cash and signing a 30-year mortgage for 100,075. I don't know why they didn't just round those, but who knows? We'll probably see here in a minute. Probably to make it this perfect $600 a month. Okay. So that'll be 6% interest and is payable in $600 monthly payments. Okay, which includes principal and interest beginning January 31st. Okay, So we are going to debit the building. That's our asset. Okay. This mortgage is backed by that building. Okay. Rather than something else where you just borrowed money and there's nothing really securing that debt. Okay. Because if they default on this, they whoever the lender is can foreclose on that building and take possession of that building to get their money out of it. Okay. So we debited cash, I'm sorry, credited cash, and we credited the mortgages payable. Okay. And here is an amortization table that is a little bit different than the previous one. And so you will see now we have our beginning balance of that 100,000. And if we take, let's put this in the calculator. I want you to see where these numbers are coming from. So if we take that 100,075 and we multiply that times that 6%, we have to divide it by 12 because that 6% is, they actually give it to us right there. That 6% is an annual amount, okay? So we had to divide that by 12, okay? So what is that $500? That $500, they just rounded 538, okay? And that is how much interest will be applied to that payment. Okay. So the difference between the payment and the interest, this is how much will bring down the interest. Okay. It's not a whole lot on the front end because I told you some of these on the front end, there's a lot of interest on that. Okay. Notice how the interest portion is continuing. Trying to get my screen to do the right thing here. Notice how that interest expense is going down as we go on. And the principal, as time goes on, that principal is going up. More of it is getting applied and it's making that ending balance go down. Okay. So the change from here, sorry, there we go. The change from that ending balance from here to here is the difference between the 99.62 that got applied to the principal. Okay, this is exactly how home mortgages work. Every single month, part of every time you make that payment, part of it is being applied to interest and part of it is to principal. Okay, all right, so the first payment, cash is going to go out of 600. We're going to debit mortgages payable for the 99.62 because that's what's bringing that mortgage down. And then we have interest expense of $500.38. Okay. All right. We're fixing to get into bonds, learning objective 14.2. We're looking at bonds. Bonds are very long-term debt. They are usually sold in $1,000 per bond increments. Okay. There's a lot of things going on with bonds. There is a face value. Face value is what is printed on the bond. Okay. A lot of students, I've had so many students over the years, they get really confused on bonds. Um, and so I've tried to be a little clearer on it because our interest rates are going to vary, and they're going to vary because when they print that bond certificate, they're going to print a face, they're going to print an interest rate, but that's probably not going to be the interest rate when the bond is actually issued. I was very blessed in the fact that while I was going to college, I worked as a bookkeeper and I would literally go to class, work on bonds, and then I'd go to work and I'd work on bonds because that's what part of my job was. Okay. So, so I learned a lot. I actually prayed for a bond problem on the CPA exam. Can't remember if I got one or not, but I prayed for one because I loved the bonds. Okay. But they can be very confusing. Okay. And I do realize that. So face value is what is printed on that bond. Okay. Sometimes it could be called the par value. Remember, we talked about par value as in the corporations, it's that legal amount of the capital. Well, the face of a bond could also be called par value. Okay. It could be called maturity value and it could be called principal amount. Okay. This is how much has to be paid back at the end of the bond's life. Okay. So we have, I like how they're doing this. They're giving us all these different terms that mean the same thing, and I love it because I always try to put that in there because sometimes your homework might ask you for a stated rate, and then you might see where it says face rate. Okay, so stated rate, this is printed on bond. Okay. You could also even go back on that principal par value. This is printed on the bond. Okay. It's printed on the bond. Okay. Stated rate. That is what they call it. They sometimes call it the coupon rate because a long time ago there would actually be coupons that you could detach from these bonds to get your interest off of them. Okay. It could be called the face rate. I usually call it stated rate. I don't really call it these, but I do know they could be called that. Okay, so we have nominal rate, again, printed on the bond. Okay, so here we have a 5-year, 9% bond issued at face value of 100,000 on January 1st. Will pay 10 semi-annual interest payments. That piece of information will also be printed on the bond. Okay. It'll pay 10 semi-annual interest payments of 4,500 in addition to the face value payment at the maturity date. So the cash flow pattern for the bond is as follows. Okay. Um, Real quick, before we kind of get into that, this is an example of the market rate being exactly equal to the stated rate. I just kind of wanted to throw that out there because we are going to get to where they're different. When I'm working a bond problem, I write out a couple of things to make sure I don't miss anything. So I get this blurb of information. Okay. So I have the face, what is the stated rate? I'm going to pull market rate down here. If they give me market rate, I'm going to put that in my blurb. Okay. We want to know interest payments. How often are they making interest payments? Are they making them semi-annual, yearly, or quarterly? Okay. And all right. So they're giving us all that. Oh, and how many years is it? Okay. How many years? So I'm just going to kind of do my blurb of information right here. So the face here is 100,000. Stated rate is 9%. Okay. And the interest payment dates are semi-annual. Okay. How many years? It says 10 semi-annual interest payments, so it is 5 years. They did not tell us market rate, but since they didn't say anything about it and it looks like we borrowed 100,000 here and we paid back 100,000, the market rate is probably exactly 9%. Okay? So in a bond, there are two cash flows. Okay? So right here at January 1, we're issuing $100,000 of bonds. Okay. We're basically borrowing money. Okay. This is how we pull money into our business. Okay. Every 6 months, there is a $4,500 payment made. Now, I want to pull my calculator back up here and I want to do this again for you. Remember, interest rates are quoted at an annual amount. Okay. So we have our 100,000 multiplied times 9%. That's 9,000. That's for a whole year. They multiply it times 6 divided by 12. We can cut that in half. And I didn't do it right. 9,000 divided by 2 is going to give us 4,500. Okay. Okay. Those are all things that are printed on the bond. Okay. That amount is going to be the same. Okay. You're always going to pay what is printed on that bond. Okay? Because it's a contract. Okay? All right. We could have several different types of bonds. We can have term bonds. They all mature at the same time. We have serial bonds where they mature in different installments. Secured bonds, there's going to be some kind of asset that's backed up. A lot of bonds are just what they call debenture bonds. Those are unsecured. They're backed only by the credit worthiness of the bondholder. Okay. Interest rates going to be higher on something like that that has no backing. Okay. All right. So now we're going to talk about bond prices. Okay. And it goes back to the stated rate is printed on the bond. Okay. But the market rate and the stated rate are probably almost, if they are actually the same, that is probably the very coincidence. We always do a problem in these bonds so you can see them being the same, but then it helps to explain why we have one at a discount and one at a premium. Okay. So on the discount, this is where the market rate is higher than the stated rate. Okay. When we have a premium, the stated rate is higher than the market rate. Okay. So on a discount on bonds, we had to discount our bonds because everybody else's bond is paying more interest than our bond. Nobody wants our bond. Okay. They want everybody else's. So we have to discount that bond just to get it to yield the market rate. Okay. On a premium, everybody wants our bonds because our bonds are paying more than everybody else's, what the market is. So we're going to ask for a premium on this. Okay. All right. So here is this is more like stock market kind of stuff or bond market. I don't think we need that. All right, let's jump on down here to present and future value. This is where the time value of money comes in play. And there's an appendix to this chapter where they actually do present value and future values. We don't really do a lot of it in the middle of this chapter. You will do more of that when you get to financial management. Okay. But time value money is just recognizing that money earns interest over time. Okay. And that's what a lot of people don't understand when they think about debt. They just look at debt as that's extra money. You don't really think about the fact that inflation is more than the interest rate you're paying. So our mortgage, we built a house in 2021. Our mortgage rate is like 3%. Okay. We had 8% inflation just last year. Um, that's great because my dollars went further back in 2021. So it's a good thing that I financed my house because now my dollar isn't worth that much. Okay. A lot of people don't think about that. And in that case, you're making money. Like it's not physical money coming to you, but your dollar is going further than other people's dollar is. Okay. And so when you're doing time value money, you want to compare apples to apples and oranges to oranges. Remember, I said don't look at that total of all the payments over 30 years. Don't look at that. That's a useless number. It doesn't matter. We just don't look at it because you're not comparing good numbers. So we want to bring numbers into present value, or we can take them all to future value. We want to make them in the same area so we can have a really good comparison. They do this a lot, like I think right now it's September of 2025 and the lottery's like way up there. I'm not buying a lottery ticket, but it's way up there. But whoever wins that, they're gonna have an option. Do you want your lump sum now or do you want it spread out over time? Well, there are problems that we work that shows us would it be better for us to take all the money now Or would it be better to take it in installments? Most of the time, it's a better deal to take it all at the front, but it just depends on what the interest rate is as to whether it's good or bad to do that. Okay. All right. So let's look here. We are going to assume that we have $1,000 bond, reaches its maturity 3 years from now, carries no interest, and it's $750 is a fair price. Okay, so by us investing $750 right now, we'll receive $1,000 later. Okay, we're going to earn $250 over the next 3 years. Okay, so you can see how dollars today are not the same as dollars 3 years from now, even a year from now. Okay. All right. So I kind of already talked a little bit about that right there when we were talking about discounts and premiums. Okay. Stated rate printed on the bond. Okay. Market interest rate. That is what everybody else's bonds are paying. And there is a bond market, just like there's a stock market. Bonds trade, and they have a market rate of interest. Okay. So I did a little bit of this. If the stated value and the market rate are exactly the same, then the bond is what they called issued at face. Okay. The discount market rate is higher. Remember I said everybody else's bonds pay is paying more than our bond. So we've got to discount it to actually sell our bond. Okay. When the stated rate is higher than the market rate, then our bond's paying more than everybody else's. Everybody wants our bond, so we're going to charge a premium for that bond. Okay. All right. So borrowing by issuing bonds payable, it does carry a risk. The company may be unable to pay off the bonds and the related interest. However, debt is less expensive source of capital than stock. Okay. And does not affect the ownership percentage. Okay. So earning more income on borrowed money than the related interest expense is called financial leverage. Lots of companies use that. That's why I tell a lot of students when you are in the business world, you cannot follow that no debt policy. Okay. You want to grow your business and you may have a really good idea that's not going to wait for you to save up enough cash to go into it no debt. You need to get in there and you need to earn your money now. So you're going to have to borrow some money. Okay. All right. So here we have a problem or just an illustration on issuing bonds payable versus issuing common stock. Okay. So plan one is to issue 500,000 of 10% bonds payable. So we have net income of 300,000. We're going to expect income on this new project before interest of 200,000, less the interest expense, 10% on 500,000 gives us the interest expense. Project income before taxes gives us, or yeah, the tax rate is 21%. That is actually the corporate tax rate right now. And so we're going to take that project net income and we're going to add it here to the net income we already had. And we end up with net income with a new project of 418,500. And our earnings per share is $4.19. Okay. That's earnings per share. Plan one, because we didn't issue shares of stock. Okay. Notice this earnings per share is going to be higher than this one over here. Okay. So if we come over here and we issue 500,000 of common stock, we still have our net income that we're starting out before the project. And we're going to get the expected income from the new project. We don't get a interest benefit here. Okay. So we're going to be taxed at the entire amount. See, here we was only taxed at 150,000. Here we're taxed at 200,000, which leads the project net income to be more, 158,000. But now they issued shares of stock, so they have to take a little bit higher net income and divide it by a lot more shares. So you can see here why it would be more beneficial for a business to issue bonds than it is to issue stock. Okay, so you can clearly see those numbers and see how that leverage works. Okay, all right. I will see y'all in the next video for Learning Objective 14.3.